Hey, good afternoon, everyone. How are you doing? Thank you so much for tuning in to the 2023 M&A and Alternative Investment Forecast webinar hosted by none other than Fogel and Potamianos. We have an amazing group of panelists today joining us with a wide range of expertise in these areas. And so I'm going to go ahead and just introduce our panel today. We have none other than Jerome Fogel, co-founder of Fogel and Potamianos. And Jerome Fogel is head and member of the corporate practice group and chair of the sports and entertainment group here at Fogel and Potamianos. And he's known as a deal maker and innovator in the legal community. He represents successful entrepreneurs, corporations, and sports and entertainment stars. He also serves as the go-to offsite general counsel for a number of small and lower middle market companies. Good morning, Jerome. Thank you so much for hosting this today. We also have Cesar Bello with us. Good morning, Cesar. He is a partner at Corbin Capital. He leads the way in the firm's private investments program and their efforts in litigation and finance, and also focuses on private credit transactions, including private credit secondaries and continuation funds, structured credit transactions, manager seating and workouts. He is a member of the Credit Investment Committee, Multi-Strategy Investment Committee, Operating Committee, and co-head of the Racial and Social Justice Task Force. Welcome, Cesar, to the webinar. Next, we have Shawn Flynn. Shawn Flynn, he's going to be my co-host. He is the principal at Global Capital Markets. He is also the host of an amazing podcast called the Silicon Valley Podcast. Shawn is a mid-market investment banker with a focus on mergers and acquisitions and raising growth capital, both debt and equity. And as we said, when he is not doing webinars like this, he is hosting an amazing podcast and supporting other people and just being a crazy networking beast. Welcome, Shawn.
Christina, it's a pleasure to be here. Thank you.
So good to have you. And next up, we have Cara McCarty Abbott. Good morning, Cara. Cara is the founder and CEO of Better Leave, the leading digital health platform on a mission to provide grief care to millions. I love that so much. Cara is also an advisor for the Founder Institute and a partner at the Fund Austin and a member of the Forbes HR Council. Come on, accolades. Oh, thanks for joining us, Cara.
Happy to be here.
And next up, one of my favorite people in the whole wide world. It's Constantine Potamianos, also co-founder of Fogel and Potamianos here. He focuses a lot on our corporate practice. He's also served in the military and served our country for many years in special operations. So thank you, Constantine, for also being here.
Thank you, Christina.
Well, hey, if you're here, if you want to jump in the chat and say hello, and you could tell us where you're from, we'd love to hear from you. But we're just going to get right to it because there's just so much to cover here. And I know one of the things, and we want to kind of jumpstart it with this, one of the things that was in the headlines, obviously, this past week was the FDIC shutting down and taking over Silicon Valley Bank, and there was this big scare for startups. So I want to know from you guys, how does that affect the forecast of the future of M&A and alternative investments for 2023?
I mean, I could start on this. First off, for everyone that's here that doesn't live in Silicon Valley, I mean, you could imagine how kind of crazy it's been here, where you're at 24-hour finish some gym, the person next to you is talking about the exposure they have, or they have a friend that has exposure, or, you know, you're talking to someone from Wells Fargo going, oh my God, $1 billion transferred to us. This is the greatest time of my life. So conversations are all over the place here with what's going on. And it's not just, you know, this Monday when the government stepped in, everyone was quiet. No, that's pretty much top of mind everywhere, with people just having conversations going, okay, portfolio companies you're working with, were they able to transfer? Are they going to make payroll? Are they going to, I mean, there's still so much uncertainty and doubt, even though at the same time, the news is making it sound like it's already done. But what's going to happen with all the, you know, the next dominoes? And what I mean by that is not so much maybe the next bank, but what about, you know, venture debt? Silicon Valley Bank was a huge player in that market. There's so many startups that were kind of counting on this to extend their runway, and you know, who's going to pick up the slack there? What is going to happen with alternative financing? I mean, there's just so much that that incident last week that suddenly happened. And depending on what side you're on, maybe people are saying, hey, there's a week or two notice, who knows what it was, but that's on the top of everyone's mind for extending runways, for what they're going to do for it's still the hottest thing right now, and without a doubt, I would say, in every conversation. So I mean, what's going to happen there? And Cesar, jump in and add a lot more.
No, I was going to say, I mean, so we don't do as much tech in early stage, right? So we're a hedge fund and focused more on later stage. But I mean, the ripple effects of this stuff were deep and wide, right? So a lot of people outside of the tech sector, banked with SVB, and then the contagion started spreading a little bit to First Republic. And there was just more general concern about the regional banks. So then, what would happen logically if the FDIC hadn't done anything, and what may still happen is what everybody's going to just put their money in the big four banks that are kind of too big to fail, JP Morgan, et cetera. Is that what we want from a policy perspective? I don't think so, right? We don't typically want to give these banks kind of monopoly power. So there's a lot to think about, beyond just the tech sector. I mean, we felt it, in very sort of unexpected ways in sort of regular finance world, right? I mean, and the market obviously feeling quite fragile at the moment, and people are hesitant to do things when that happens.
Oh, go ahead, Constantine.
I'm sorry, I was going to throw something in. A couple of weeks ago, or maybe more, when we were just kind of chatting, Cesar, you had talked about the ripple effects of the interest rate changes kind of across your industry. And I think we're seeing some of these, maybe a little bit more than a ripple effect that's working through the banking sector, right? And it, even though Silicon Valley Bank made the big news the other week, let's remember, right before that, we had Silvergate and Signature Bank, both affected by the crypto markets, which are, part and parcel of technology, or subset, however you want to call it. But I think that was probably part of the effect on Silicon Valley Bank. And now we're seeing beyond that. And the question becomes, okay, are there fundamental reasons for this that we need to be concerned about? Is this a more of a panic effect that we're hoping will kind of, people will come to their senses and say, okay, we don't necessarily need to do a run on First Republic or some of the other bigger institutions out there? Or is there something more fundamental going on that we need to think about?
Yeah, I would say it's a little bit of both, right? So if you think about how banks work, no bank just does nothing with their money, right? So they're supposed to keep a certain percentage of deposits, but the rest are supposed to invest, and they don't run their business anticipating that people are going to ask for their money back all at the same time. So they're all susceptible to a run on the bank, right? So that part of it is psychological. But when you raise interest rates as fast and as quickly as the Fed has, then innately kind of things are going to break at some point, and you don't know where or how, right? So Silicon Valley Bank, was doing certainly riskier stuff. I mean, they had 10% of their deposits, sounds like, in venture. The $20 billion book, that's pretty big. And being in that market, because we invest in some venture lending funds, we always saw them as sort of cheap capital. So, good for the founders, et cetera. But, from a credit perspective, didn't have a super high opinion. And then obviously they did a very poor job managing interest rate risk. They didn't have a chief risk officer for like 8 months. They didn't hedge against interest rate risk, which is kind of crazy to think about. So they ended up owning all these long dated, mortgage-backed securities, 10-year securities that they bought when they were yielding 1.2, and then as rates went up, those things dropped in price to, by 25% or around that. And then you start getting an asset liability mismatch. And then if people start getting concerned about it, they start pulling their money, and then the psychological part of it hits. So, it's a little bit of everything, and it was an interesting response in the market because you saw like a flight to quality, right? Treasury yields dropping, right? People going to the safe stuff, but normally when that happens, you see the stock market crashing or going down, right? In this case, it didn't. It held up, and why? Well, because the Fed is now signaling that they're not going to raise rates as much because we're worried about the market. So where does that leave the equity markets? And they've been kind of flattish. So they haven't reacted the way they normally do when there's a big flight to quality. So there's we're in new territory in a lot of ways.
Cara, I apologize. I think I interrupted you when you were about to say something.
No, I think this is really good conversation. I wanted to jump in from a different perspective as an early stage investor and also as a founder myself. I think two things: quality and building confidence in the banks that you are going to move forward with or stay with is really important, and also the communication strategy. So I'll give you an example. Mercury did a really good job while the chaos was ensuing to say, we've decided to increase the access to FDIC insurance up to $1 million. And they did that within like 48 hours, right? So they're trying to build confidence within the folks that are still banking with them. And I think from an early stage founder, it's something that we didn't think you're going to have to do due diligence into who you bank with, right? This is just another complexity layer that I think now we're all just going to be aware of. And I think the groups that are going to win and really get early stage banking from founders and also early stage investors are the ones like Mercury that come out proactively with several communications. What are they doing to build trust? What are the new products they're rolling out? I think even today I got another email saying that they've come out with a new product, Mercury Vault, and maybe even increased the bank limit even more than $1 million. So I think there is going to be a real opportunity for winners here. And I think from an early stage VC perspective, how that's going to impact as we do due diligence on companies, we're just going to add that to our checklist, right? So we're going to say, okay, how are your funds diversified? What do you use? What's your infrastructure? Now we're going to think not what's your, in addition to what your tech infrastructure, but what's your operational infrastructure look like? And I think that's just something we're going to add as we assess things, as a part of the fund Austin.
That's amazing. And you guys, so it seems like this has affected the forecast quite a bit. And for startups, I love what you asked, Constantine, because I feel like as someone who's not in that world, I saw a lot of talk going around about people pulling their money out of banks and everybody, like just regular run-of-the-mill folk getting really scared about this. But I think this is really just affecting companies and startups and things like that. So how should companies prepare then for this year, for 2023? What should their expectations be in light of this forecast, this market?
Well, I think, and everybody can chime in. I think it's clear kind of across the board that it's a more cautious and slower investment environment right now. The sources of funds, anything from angels to institutional players, VCs, et cetera, are looking much more carefully and taking more time on investments. And I think we're seeing a lot of companies recognize that and trying to be as careful with their existing stock of capital as they can be. They're trying to keep powder dry because they don't know how long this environment will be difficult, or I guess I should say certainly more difficult than it's been in the last couple of years or so.
So you mentioned them being careful. What could they do to actually make themselves more attractive in this environment?
That's a good question, and that's a good question posed to the panel. So Cara and Shawn and Cesar can weigh in on that.
Sure. I'd like to take a stab at it. Having those conversations with companies of, how are you preparing different than before in your processes? Do you have backup vendors? What's your customer concentration? All those things you'd always hear in the past of, the value drivers for a company are, being brought up and more emphasis on it. What are your plans for, your for earlier stage companies in that, your runway, what is it? Is it 12 months? How are you extending it to 18? Where's the fat that you're trimming? Is, 100% growth this year the right number, or is it, scaled back a little bit? Because I mean, one of the things that's coming up in a lot of conversations with companies are, they thought their investors, their board or whoever would give them a bridge round, that the money would be there, and they have conversations now and they go, wait a second, it's not. I don't understand. I thought we were good to go if we got into a little bit of trouble. And there's a lot of wake ups, a lot of surprises with a lot of conversations, and having those early, I think people are a little bit more aware of now that, listen, you can't wait till there's 2-3 months left of money in the bank to have these conversations, that maybe in the last few years there would have been, someone there that someone knows that would write a check and get you through because, capital is cheap. But now you need to have those conversations way in advance and really plan things out and look at those different situations and more planning, more conversations in advance with a lot of people. And I see Cara's head shaking, so I'm gonna hand it off to her on this.
Well, I love what you said, Shawn, because I do think that there has been maybe a mismatch of investor and founder valuation specifically too. So you talked about that bridge round, and you said, we thought they'd be there, but then again, they thought even if they were going to get a bridge round, it might have been at the next step of valuation. And I think we're seeing a lot of flat rounds or down rounds that were completely unexpected. And so we always tell our founders, be realistic. Get signals from the market, get different opinions from different groups on where you think you can, where you should be valued at, but also where you can raise funds. And if you can only raise funds at as a flat round or a down round, like right now, we're encouraging people to take funds, extend their runway significantly, even if they're not thrilled, right? And so I think it's just that expectation setting. And also the time. You're right. As the good old phrase, time kills all deals. It's how, as a founder, do you continue to push to get your raise closed, but also knowing that it is taking a lot more time, a lot more diligence. We're seeing folks not really willing to commit to a deal until 75% of it's been committed or around there. And so I think those changes are definitely different than even 24 months ago when you saw people commit and be the very first check-in and no other commits needed. So I think that construction is also changing a little bit around commitments and signaling on how the round's coming together. So totally agree with you there, Shawn.
And Cara, I got a kind of a question for you and the panel. I kind of want to see what you're seeing here. Are you seeing this kind of, I don't want to say cat and mouse, but kind of this battle between companies and valuations and investors, where it's kind of this stalemate where the investors are going, hey, you have to come down these valuations, and the company's going, no, we're going to keep them up here. You have this money you have to invest. And this like stalemate where they're just looking across the table of, okay, who's going to break first? Is anyone else seeing this as well? I mean, I've been having conversations with VCs in the Valley, probably I'd say 4 months now, where they're saying, yeah, the startups, their valuations have to come down. And the startups going, hey, no, those VCs, they raised money 2 years ago. They got to start deploying it. And you're just like, well, who's going to run out first? What's going on here? So is anyone on the panel seeing that?
I think it's a really interesting point. So just to take that a little deeper, right? So obviously founders are hesitant, to do a down round. But think about why, right? So a lot of the employees they've hired and the way they retain them with stock options, right? So, if you're going to re-rate to a level where that stuff is kind of worthless or they're out of the money, then they're worried about people leaving, right? So there's knock-on effects to sort of doing a down round that are serious. But at the end of the day, your runway is your runway, and if you run out of money, then everybody's out of a job, right? So that's more of a continuation of something that was already happening, though, right? Like the come to Jesus moment from the startups sort of get real about, hey, how do I survive in this new environment when cash is not so readily accessible? And I think the VCs have been pounding on the companies to do riffs, to get more prudent, to think about runway. But then you layer in now, all of this uncertainty and institutional sort of fragility with the banks. It's tough. The one upshot, maybe silver lining, is, well, now rates are going down. or at least not as high for as long as expected is sort of what the forward curve is telling you. So, a little bit something in there for everyone.
I would add too, talking to VCs, one VC I talked to, when I talked to him about what deal sourcing looks like for him right now, he just said 3 things: team, team, team. So he said, obviously, even in this environment, you're looking at the team and, how can they navigate the challenges? Are they going to be judicious with the money? And so I think that's still a huge concern. Also, for VCs that have been sourcing deals, for the last 2-3 years, they've got their eyes on these targets, and maybe they're doing follow-on investments and deals they already really like. So, they have some comfort level. They've already diligenced. They know the team. So I think I'm seeing more of that. You're seeing, maybe more bolt-on acquisitions on the PE side, or shoring up, capital funds. So I think there's definitely a flight from risk into more known quantities. But I do think that a lot of the VCs have soft circled certain companies that they know they want to invest in. And I think they're still continuing to do that. Obviously trying to get more favorable terms. Maybe they want to squeeze out bigger warrants. Maybe they're trying to get advisory shares, or they're trying to get a little kicker in some of the valuations and things. They know that they've got some leverage. But I'm also encouraging, clients that we represent, because we do both sides of it, is that, don't put up so many impediments to the deal, like drop some of these. Sometimes founders kind of get wrapped up and fixated on certain issues. And I think you just kind of have to let this go. If someone's, if someone's going to put in funds, you've got to just go with it. And then on the VC side, I think you have the targets, the companies you want, try to get the best deal you can now. I do think, Shawn, to your point, there is some waiting going on, and they're saying, hey, I don't have to invest now. I can wait till, the cash is going to run out. They're going to be more desperate. So I think that is going on too. And I definitely see it too.
There's a follow-on point that's worth making that hits on what Jerome is saying and what Shawn was saying about down rounds, and we're talking about it. And you see this hesitation on the side of companies to take on capital, particularly in a down round situation. They're like, okay, we'll bite the bullet, and we need, X, we need 25 million, or whatever the case may be, right? And I've always counseled people that if you have money available to you, take it, right? Don't decide that now, you're going to take the minimum that you need because things are going to get better before you need more, and you'll be able to get whatever you want. There's this, I think, false economy that occurs with that mindset, right? Because to another point that I think you, Shawn, made, people forget how labor intensive it is to raise capital sometimes, how much time and effort it eats on the management side, how that detracts from operational goals, everything else. So if you have an opportunity to take in capital, even if it's a little bit more expensive, particularly in a time like this, I would counsel companies to do so, and to just, obviously still be judicious with it, but, overestimate the amount of capital you'll need versus underestimating.
Yeah, I strongly agree with that. When you can get liquidity, get it, especially at a time of uncertainty. But to circle back to Shawn's main point, I think in that Mexican standoff, the VC funds win, right? Because they don't have to deploy, right? They ultimately, do in the end, but there's an investment period. They've got years. Like, the company's running out of money, will run out of money and hit a wall, right? So, I don't think we've seen all that shake out yet, but in the end, I think that's where it goes. And another thing that we haven't talked about much is, like, I don't want to sound super doom and gloom here, because out of all this sort of change and chaos, there's a lot of opportunity, right? So we have a bunch of venture lenders. I think I mentioned this earlier, that are licking their chops now that SVB is out of the market, right? Deals that they got priced out of or lost term sheets on are coming back to them, and and better because there's such a time of scarcity. So, from a private credit venture lending perspective, this is a great time if that's your business with the big, gorilla in the room out of business.
I also just wanted to make a point, Jerome, to what you said around like team. I think if we look also at the changes in talent, right? We had tech talent moving out of Silicon Valley 24 months ago saying, I'm not coming back into the office. Like, I'm not going to take a lower salary. Like all these changes, they're saying, no, it's employee's choice. And then we've seen a shift of mass layoffs. And now it's not really, and that kind of has shifted away from employee choice. So I think as you think about that as an early stage founder, right now should be the best opportunity to find talent and build. And that's definitely what we're seeing too. We're seeing where they couldn't get certain talent a year ago, now being able to get that talent. And so I think that's definitely a silver lining or a positive that's come out of some of the recent events.
That's a great point, Cara. And that just kind of leads to like what other opportunities, and we've been talking a lot about like all of the risks and the doom and gloom, but like, are there any opportunities in this environment?
I'd say there's always opportunities in, especially, I mean, it was just mentioned right now by Cara, all these engineers that were laid off. Well, how long do engineers stay unemployed? 3 minutes, or they start a new company, a new project, or they have been working on something on the side for the last 18 months, and now they're going to change it from a nights and weekends thing to a full-time project. I mean, engineers, they don't stay idle. They're always creating. I interviewed, thank you for the plug on the podcast, a person from Palatine Ventures, and she said, this is a great time because with the dip of options and that, these employees are not being held, handcuffs anymore to the company. So before, when they're thinking I'll stick it out for another year or two, now it's okay, I've been working on this other project for a year. These options aren't worth what they used to. I'm going to go out and make this my full-time thing. Hey, my buddy just lost his job over there. He's coming on board. Hey, my other friend over there, now we've convinced him to leave this or her and join. Now we got to start 6 months from now. We're going to go out to our network and raise capital. People are active. They're moving. The news is making it seem gloom when 7,000 engineers are lost here, but those 7,000 are now creating this many hundreds of jobs or companies over here, and that we aren't going to hear about for a year or two, but they're active. People aren't idle right now. At least that's what I'm seeing. All I'm seeing is people pitching ideas and come up with new solutions, and it's pretty incredible.
Oh, someone had a great little sound there. I don't know what that was.
Oh, I don't know. It was an alert from my end, so I apologize.
Constantine, of course. So one of the questions that we asked in our intro call that we had was, we were talking a lot about interest rates and higher cost of capital and how that affected financing. You guys want to talk a little bit about that?
Yeah, I mean, I would just say it's insane how quickly it's shifted, right? So, a week or two ago, people were predicting a terminal rate of like 5.6, 5.7%. And instead of going like this, now it went like this. So now, all of a sudden, based on people concerned about if we continue to increase rates from here, just break the market, expectations are that the Fed will maybe raise slightly or hold and quickly start to cut rates. So is, what a difference a week or two makes, right?
I would add too, and Cesar, you mentioned this, you mentioned the venture lenders licking their chops. I think the regional banks play an important role because the big banks have a very tight credit box. And so like we've had, clients that, one client that did like a $50+ million credit facility with a regional bank. And, that deal wasn't going to happen in one of the big banks, and they're a great company. But so I do think the regional banks play a really important role. And the Feds, there's a lag. It takes 1 to 2 years for the full effects of the rates to kind of take hold. So I just think they raise rates so quickly, and Silicon Valley Bank got caught in a really bad position with what some of their investment choices. And but I do think in terms of the interest rate environment, I do think what I'm seeing is family offices like stepping in. You know, they've got cash, so I'm seeing that happening. I think you're going to see more deals from family offices and sovereign wealth funds. I do think, I mean, it seems like interest rates will either go, the market's pricing in either down or stable. And if they continue to go down, then I think that, you know, the M&A activity kind of on hold till Q4, Q1, the majority of next year. But some of that stuff could accelerate if, you know, cost of capital comes down and, you know, we're able to push through. But I do think that we're kind of in a little bit of a holding pattern in terms of, you know, what's going to happen on the M&A side. I think people are just kind of in a pause and wait and see kind of mode. But I do think, you know, having those regional banks, to reiterate the point, is really important for a lot of deal flow that gets done that was not going to happen just at one of the big banks. So interest rates, I think, play a big part of that.
Yeah, and just to hammer that, I think from a policy perspective, the Fed and the government would be not happy if all we ended up with was JP Morgan, Goldman, Bank of America, and Citi, right? Because all the regional banks failed and everybody was scared and moved their money to the big guys. That's not good for the consumer. That's not really good for anyone, right? For systemic risk, et cetera.
It's not good. And what's happening now is, I mean, I was talking to somebody who's CFO, personal CFO for a lot of companies, and, you know, all they're doing the last week is moving money. And he told me, he told me he had one client that had 90 million at First Republic, and he said, you got to pull it out. You can't, it's just not worth the risk. And they're having to make those decisions. And then when you accumulate all those decisions together, like, you know, there's only a fractional amount of reserves that are available. So I agree on the policy perspective. It's not good to have just big banks. Those regionals are really important. And there's got to be some more confidence. I know that banks put in 30 billion in temporary deposits. So the market hasn't reacted favorably, it looks like, today to that, but we'll see.
Yeah, and look, I would say First Republic's a great bank, right? I use them personally. Their balance sheet's quite strong. But once you get the run going, you know, it's really tough to stop. So I hope they make it. They're a conservative bank. They didn't do a lot of the stuff that Silicon Valley Bank did. But everybody kind of gets, you know, caught up in the dust cloud.
Yeah, I really was pretty surprised by the First Republic situation, because they are so far removed from kind of the
Yeah, but I think it's what Jerome said, right? Like, what is your upside, downside versus staying with them? Well, there's not a lot of upside and there's a lot of downside. So everybody just errs on the side of pulling their money and saying, F it, right? We even had a manager of ours who only had a First Republic account and didn't have a backup. Just returned the money to us and kind of made it our problem, which is fine. I mean, I'd rather have the money and we could deal with it, but, you know, I think not too many people are willing to take the risk, you know, and leave the money in, hoping for the best, right? Hope is not a strategy, right?
Yeah.
One of the things you talked about, Cesar, was focusing on portfolio construction and figuring out the type of risk. Can you elaborate a little bit more even on that?
Yeah, I mean, I think, you know, to everyone's point, people are being cautious and kind of, you know, clutching their purse strings right now and not really that eager to put risk on. So you want to be really intentional with the risk you do take. Your sort of cost of capital has gone up. So especially if you do anything illiquid, you want to get more of an illiquidity premium. I think about kind of private markets a lot more than public markets. So you know, it's like, hey, if there's a lot of disruption in the public markets, and that stuff is liquid, maybe there's some opportunity there. So if I'm going to take away dry powder that I could use for that to put in something that's illiquid and I'm going to be stuck in for a while, then I really need to be getting paid for it, right? So, but you know, there's no substitute for basic blocking and tackling, like, you know, just operationally making sure you've got a backup bank. You know, your number one goal is to preserve capital, right? So if you're leading with that, you know, you'll be okay.
And I think, you know, we focus Jerome alluded to this, but we've been focusing on talking about some of these big banks and the issues that they've had. But it does also, potentially open up opportunities for regional and smaller banks. There's a lot of acquisition financing and other financing that's coming out of smaller banks that, is still happening. And there's other business as well. Following the Silvergate situation, I was talking to some guys that had gone from Silvergate to a small regional bank to open up the digital assets practice there. And I said, how's this affecting you guys? And they said, for us, it looks like an opportunity, with Silvergate and Signature kind of out of the picture right now, we have an opportunity to grow this. So, this is obviously it's disruptive to the big institutions affected and their depositors, but it also opens up new opportunities for other players. Shawn, I don't know if you're seeing that in your kind of investment banking environment with any lenders, some of your clients are working with, et cetera.
How do I say this? I mean, right now the conversations are all over the place because people are still trying to, find the skeleton, see what's going on, ask questions, exposure, everything. The interest itself, maybe this is a little bit to the side, but what I found kind of interesting in this last, let's say, 6 months or whatever, is the interest from the private equity guys with the money on the side, the dry powder, and less from the strategics, where it kind of looks like the strategics are, hey, we already made a ton of acquisitions over the years, and now let's kind of incorporate these and do that post-acquisition, really combine the companies. So it's interesting there who's reaching out to us looking for targets, who's having the conversation, what's getting a lot of interest, seeing the ones with maybe, whereas before, the strategic looking for, I don't know, more something some type of technology to roll into. Hey, we're looking for companies with, good EBITDA, good, strong cash flow. So I know this is taking the conversation a little bit to the side, but what type of conversations are the rest of the panel having out there when it's coming to, their companies they're working with, their clients, and the interest in the market for them?
I would say on the hedge fund side, clients are taking advantage of the volatility in the market. And I would say on the venture side, it's, and I kind of alluded to this too, it's, they've got a list of, hey, they've got a list of banks maybe that they've internally identified, and they're kind of keeping that as like a part of their diligence checklist. Like Cara, you had mentioned that, like having part of your diligence. So I think that they're looking at banks as part of the diligence moving forward. And so they're looking at that really, really heavily.
Well, and I also think alternate opportunities of funding, right, outside of the traditional one. So as we probably have all been hearing, the tax credits, right? It's everywhere. It's super popular as a way, like R&D tax credits. But what about like revenue-based financing? So I think there's a group, Wayflyer, that offers, a type of funding based on your average monthly revenue. Or, we talked a little bit about venture debt, but even reoccurring revenue-based financing. So there's a company, CapChase, right, that can also provide a line of credit based on revenue. So I think to your point, Jerome, like doing your due diligence and investigating every type of option that you have, I think you're gonna learn a lot more than you ever thought you'd have to learn about, not only how to diversify your fund, but diversify your financing options too.
Yeah, that's a really good point. So like, be creative, think about where you can get money. It doesn't just have to be equity. We have a lot of ARR lending partners, and this is great for them, right? Because, if you don't want to do a down run, you don't want to dilute yourself as the equity, well, you can borrow money and get a bridge, get you by, and to hopefully, raise it a higher valuation. And before you're competing, with the venture lenders, well, biggest one just went away. So this more esoteric kind of ARR financing is a good option. I think it's another tool.
Are there particular sectors? I mean, we're talking about financing, right? And we're talking about what the financing environment is like. I don't think we can talk about that without kind of highlighting which sectors are most attractive right now versus some that are not as attractive, which I think is valuable to any company that's out there potentially looking at financing. What do you guys find most interesting and least interesting? Top three, most interesting and least interesting.
It's a really hard question. Yeah, go ahead, Shawn.
So, I mean, maybe not particular for myself. I'll just say kind of the conversations I've been having a lot more lately than anything. Companies that have some type of ESG component, environmental, social governance. I mean, gosh, I can't even tell you the number of panel discussions or events it seems that are happening in Silicon Valley over green tech, this, or it's hot. There's so much interest in that. Also, cybersecurity, our work from home for the last couple of years. I mean, that once again, all you hear is this person got hacked, this company was held for ransom, this was going on. And then when we go into due diligence with any company, hey, tell us about cybersecurity, is it on-prem or in the cloud? What's your 0 point this, or your the jargon's getting thrown around left and right. So companies that are solving those problems. So ESG, cybersecurity, also telehealth, those conversations are still coming up. And what's interesting there is the conversations were a couple of years ago where the VCs asking for it. Now I'm getting private equity guys reaching out going, hey, are there any companies that have these financials that you're talking with? Because we got some interest there. And then maybe not so much a sector, but just one thing that I think is kind of interest is the private equity guys that raised capital this last year to acquire companies that aren't able to get their next venture round, that are great companies, but just not hitting those growth numbers, but are, good companies, good acquisition targets. So I'd say those three kind of sectors. And the fourth one is just the interest of having this money allocated for good companies in any sector, but just maybe missed a few metrics that their VCs or their early investors are looking for. And, people are on the side waiting to grab those.
Mm-hmm.
Yeah. So I have a couple thoughts. So I would add to that, like on the venture side, like AI, there seems to be a lot of energy around AI. And this is not a direct response, but it's an observation. Digital assets, BTC is up 25% since Monday, whether that's because people are worried about inflation with rates coming down or worried about banks and, centralized banking. I don't know, but it's interesting and unexpected. I would say private credit in general. So we talked about venture lending, but if you have capital right now, you can kind of set your terms in the private market. So it's not a new thing. Private credit's been growing a lot recently, but I mean, I'm kind of talking my own book a little bit, but just for us, like, the opportunities in front of us, the supply of deals just gotten so much better than it was, a year ago, right? And that's only been exacerbated by recent events.
I'll just add one note onto that, Shawn. I love the mention of ESG. So I'm a partner with Lafayette Square, right? They do impact investment platforms, but they also offer a social component. So anyone that comes through and gets capital through Lafayette Square also gets access to health, well-being, and other services as a part of that kind of ESG and social commitment. So I 100% agree with you. I also think industrial tech is, so we're seeing really, really, especially on the corporate venture side, I used to be the VP of People in North America for a data ops company called Cognite. And you really see a ton of interesting things around, and maybe overlapping with AI, but data migration, data ingestion, what you do with that data, and how can you really enable that data for teams. And so I think it's going to be interesting for companies in that industrial space this year as well.
This is great. Guys, I want to make sure that we leave some room for Q&A for anybody that's here, because this will be an interactive webinar. So I want to go back to David's question in the chat earlier, and just I'll go to his comment and just read it. It said, so far, we've not seen any negative impact of the bank situation on lower middle market M&A. Buyers still have access to acquisition capital from their banks and credit funds. Yes, valuations have come down over the past 9 months in general, and credit is tighter, more expensive. But this was all true before the SVB situation. Anyone disagree?
I don't know the lower middle market as well, but I mean, certainly in large kind of, private equity LBO funds, there's been a lot less access to capital. So you're seeing them get deals done when they're buying a company with having to put more equity in, or sometimes all equity deals. And they just figure, hey, this is too expensive, this debt, our model doesn't work. We'll wait and kind of back lever it later. So, the theme when we go up market a little bit has been less stuff getting done, less M&A activity, just because there's less capital available and rates are higher. Right.
Just to add a little bit more there to Cesar. I mean, for years there, a lot of these private equity groups were saying, listen, we when we invest, it's all equity. They raised so much capital to employ, and that was kind of a differentiating factor for some of these groups, just saying, hey, we don't want to load up on debt. We want, things to move fast. And so there's a lot of these groups that were already sitting on so much capital for so long, and they're sitting on even more now. It's incredible. But I mean, for a while, there's been a good number of people that, just had so much capital as 100% equity. That's how they advertise. That's how they attract those sellers. So, yeah.
I would say what I'm seeing is certainly, like, for example, on the PE side, let's say a company, raised, 500 million to deploy. And now the last 2 years, if that portfolio either is stagnant or is basically going down, they don't necessarily have as much cash as they thought they would to make more acquisitions, or maybe they're more tenuous. So I think that they already may have been seeing some headwinds. And then I think with Silicon Valley, the bank just kind of, maybe even psychologically, created some effect. As far as direct access to regional capital, I haven't had any direct, conversations about it in the last week. But maybe anyone on the panel has, but that's kind of what I'm seeing out there.
Feel free to put your questions in the chat. If you have any questions for any of our panelists, feel free to put it in the chat and we'll make sure we get it answered for you. We also put links in the chats to each one of our panelists' bios or websites. And so if you want to get to know anyone on this panel more, or have any other questions about who they are and their experience, go ahead and you can see their links in the chat. Well, guys, do you have any questions that you think would be good that we answer during our Q&A while we wait for some of the people in the chat to throw questions in there?
Well, I got a question for the panel, I guess. Where do you guys see the exit opportunities for companies this year? Well,
I don't know, man. I feel like it's just tough to be in the prediction business right now.
Yeah.
I mean, kind of what I'm seeing is clients that are smart, working with their bankers. They're saying, okay, well, we're gonna peg Q4 or Q1. So let's now get ready so we can inspire confidence in the investor or the strategic, whoever's coming in. Let's get ready before we go to market. Let's go through all the corporate governance and UCC lien searches, and let's go through all the IP. Let's make sure that, you know, the cap table is clean and equity. I mean, kind of like time to kind of, you don't have a fire drill. So I definitely seeing that. I also think there's been some chatter in the market about mergers of equals. So this kind of idea that, you know, coming together, two is going to be better than one in synergies. And then there's going to be cost cutting and different synergies. So I'm definitely hearing chatter about mergers of equals out there. I also think that there's always talk about distressed M&A. I mean, even I really thought it was going to be bigger in 21 and 22. It really wasn't. But if companies run out of runway, and I think we're going to actually see some of it. I mean, we've talked about it, but I haven't really seen as much as we thought. So I think there could be some distressed M&A out there, and there, you know, could be some licking their chops.
Yeah. So, I mean, I don't want to sound, you know, super negative, right? Because most of the time it's not the end of the world or the apocalypse, right? So if you put a gun in my head, I don't think, you know, this is different or that there's going to be a massive recession. So there's a question here that said, hey, if you had $1 million, what would be the best place to put it? So you're getting paid 5% risk free right now, basically, you know, treasuries. So I would, you know, do that, hang out and wait for a good opportunity to present itself personally.
I just also want to add something, Jerome, to what you just said around distressed M&A. I think from an early stage lens of like seed and Series A, you know, we definitely tell all of our founders in the fund like, communicate with us like the reality of your situation, and then before you decide if you're going to wrap it up or close it down, let's look at the opportunity of like the mergers of equals, as you just said, or the distressed M&A, because I think, especially on the early stage, I think it's my prediction, it's going to have a big impact. Like you're going to see a lot of companies just throw up the towel after 3 or 4 years of grinding. And instead of doing that, like what are the opportunities there around merging?
So Cindy's asking, what type of startups are VCs interested in now? You said AI, cybersecurity, and social causes, environmental. I think that might be for you, Cara.
Well, yeah, I mean, gosh, there's so many venture groups out there that are all have their own thesis, their own identity, their own mission, their own manifesto, like regionally specific or diverse specific. So I wouldn't say that there's only like a couple. I would say do your due diligence if you are a startup founder and you're looking to and you're looking for venture capital dollars. I would say, you know, go through their portfolio, make sure that it aligns with you, the stage, the size of the companies, like what the team makeup is. So for the Fund Austin, we're industry agnostic. Now the Fund Austin has a geographically focused thesis for Texas, but we've done everything from, you know, gaming to digital health to consumer. So I would just say, you know, do your due diligence. But I don't see any constriction necessarily of VCs not doing certain deals, unless anybody else has thoughts on that.
I mean, I'd like to add just one sector that I've only just started hearing about recently that I hadn't heard ever before, that might just be an interest for people to do some research and look into, and that's the disability assisted living tech or assisted tech. I'd never really heard about it. At CES, they had a panel, met a couple of VCs in that space, met one person that's got a venture studio focused on that. And when you start hearing the numbers and the demographics and everything, go, oh my gosh, this is an underserved area. So that's something that I just recently come across that I thought was very interesting, that, you know, people might want to nerd out and research a little bit.
Well, I think you make a good point too, Shawn, just to add back onto that real quick, is underserved markets. I think aging tech is another one that's going to be really huge, especially as we're going to have the largest aging population ever going into 2030 and 2040. And I think a lot of innovation and disruption around there, and new venture groups focused specifically on aging tech, the care economy, and what that looks like. So good call out to underserved markets.
Constantine, you're involved in a lot of accelerators in Austin too. I'm assuming you've got some great thoughts here on this one.
Yeah, I mean, there is one point that I want to reiterate that you touched on, Jerome, and that we kind of glossed over because it's essentially boring and nobody wants to deal with it. But to the point of what some of the folks were saying earlier, now if you're going out for financing, there's a more deliberate due diligence process. People are looking at the details. People are trying to figure things out. Being prepared for that, if you want to close your financing quickly, if you want to not raise red flags that have to be answered, which you never want to raise flags. You never want to raise question marks in people's minds. Have your organizational stuff ready. Have it good to go. Have your agreements, figured out. If you're looking at a potential acquisition by somebody, are your contracts assignable in the event of an acquisition? Or does the acquirer or you have to go back and get a bunch of consents? All these little things that we don't think about as we're building a business quickly, but that comes to become important when you're looking at a potential exit or a potential, significant financing, et cetera. And you don't, nobody really focuses on this usually, but you don't want to be at, the 59th minute of the 11th hour, trying to get that critical financing or critical acquisition done. And all of a sudden these issues start popping out of the woodwork. Now, maybe I'm overly sensitive to that because we see it quite often. And I throw it out to Cara and Shawn and Cesar in terms of, okay, when you see these things pop up, how do you guys react to them?
I mean, when we're working with the company, wanting to have that conversation way in advance and uncover any skeletons in the closet, ask them, hey, have you built out your data room? How update is it? Get all those things, from day one and really dissect things because, well, if you do it early enough, there's still time to make some changes, make some improvement and get those value drivers, get that. I mean, there's just a question in the chat of wait 5 years, wait 10 years to go out to the market. Is like, just grow your business in a way that's run efficiently, that has the processes in order and the value drivers. And because 5-10 years, you never know what's going to happen in 5-10 years. You don't even know what's going to happen 3 months from now in the world and in your family, your personal life. So you should always be prepared or be running the business, preparing for it to sell at any time, at any moment's notice. Because when you prepare for that, you're actually running the most efficient business possible. Yeah, I mean, that's reality. So piggybacking on what you said of just, getting basically all the ducks aligned. That's really what it is. Every day, just be thinking about that. And then you don't have to, you can go out to market on your terms, not others.
Look, and if there are warts or bad things, disclose them, right? Be upfront about them, right?
Everything comes out in due diligence. Everything comes out.
Yeah, and it's
people
not
thinking
even,
they'll hide. No.
It's not even bad things, but it's like we've seen it often enough where we'll get to a certain point, in a financing or something, and they're like, okay, we got to stop. We got to fix stuff that wasn't done right to begin with. That takes a little bit of time by the time you round up, if you have various, shareholders, parties, et cetera. And it does slow a process. And we're in an environment where you really don't want to slow the process because people are hesitant as it is.
It's already been said once or twice, right? I think, Cara, you said it, time kills all deals.
Yeah.
I mean, Jesus. And we got two lawyers on this panel here.
Windows shut as quickly as they open, and so time does kill all deals. That's kind of a good saying, Cara. It's true.
So I think the optimistic way to put that is, put the time in to be prepared now for opportunities that come up, because there's always opportunities even in this environment. But you love it. We need to seize them.
I'm putting that.
We can't end on a bad note. We need to add on a high. Like there's a silver lining. Don't give up.
Well, Well,
Don't
listen,
give up and be prepared. So that is going to be the closing statement of this amazing webinar. Thank you guys so much for attending. Thank you to our panelists for just taking the time out to be part of this with us and just to impart your expertise. Hey, if you need help with any of this, that's what we're here for at Fogel and Potamianos. You can contact us at info@fpgeneralcounsel.com. We'll get this recording out to everyone. So if you were doing something else as you were watching this, or if you're tuning in late, we'll get this to everyone that signed up to attend. Thank you guys again for joining us, and have a great day.
Thank you very much, everyone.
thanks, everyone.
Bye-bye.
Thanks, guys. Take care.